What is profitability ratio analysis? Profitability is essential for every business. Even a nonprofit must ensure it operates at a level where its revenue exceeds its expenses. To evaluate profitability, investors and business managers use specific financial ratios such as net profit margin, cash flow margin, and the widely known return on investments or ROI. Keep in mind that profitability ratios are divided into two types: margin ratios, how the business can translate sales dollars into profits, and return ratios, how efficiently it can generate returns for its shareholders. Welcome back, folks, to the awesome Sweetie Kiwi Show. I'm very happy to have you today. I hope you are doing fantastic. I'm doing marvelous. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about profitability ratio analysis. Let's first talk about comparative ratio analysis. Financial ratio analysis of any ratio is meaningless unless the manager has something to compare the ratios to, right? So managers generally use either trend or industry analysis. So trend analysis involves, in this case, looking at the business profitability ratio over time and looking for positive and negative trends. So industry analysis is the comparison of a business profitability ratios to those of other businesses in the same industry sector, right? So you constantly assessing the profitability ratio of one company versus its competitors. Now, you can do internal company trend analysis and external industry analysis. Let's first pay attention to the internal company analysis. Established companies typically have several years worth of balance sheet and income statement data to work with for a ratio analysis. So if you calculate the financial ratios for several periods, say several months or quarters or years, this helps you get useful trends in the company's operational performance. We can look at, for example, let's pay attention to a balance sheet, for example. Now, a balance sheet is also called a statement of financial position or a statement of financial condition. You can do several types of internal company trend analysis through a balance sheet. How does it work? How does a balance sheet work? You have assets. So assets are typically organized into liquid assets, those that are cash or can be easily converted into cash. And then you have the non-liquid asset that cannot quickly be converted into cash. I'm talking here about land, buildings, and equipment. They may also include intangible assets such as patents, copyrights, and franchise agreements. So that's for the balance sheet. So the balance sheet, you have the short-term assets, the liquid ones, and the long-term assets, the non-liquid ones. And then you have the intangibles. Besides asset, a balance sheet has liabilities. So liabilities are funds owned by the business. This is debts. This is the money. This is money that the company owes. And those are broken down into current and long-term categories. Same thing. Short-term means current. Long-term is long-term. So current liabilities are those due within 1 year and include items such as accounts payable. So accounts payable, this is supplier invoices. You have wages, income tax deductions, pension plan contributions, medical plan payments, building and equipment rents, customer deposits, utilities, temporary loans, lines of credit, interest, maturing debts, and sales tax and or goods. Now you also have long-term liabilities. Now those are any debts that the company has to pay after 1 year. So this may include deferred tax liabilities, any long-term debts such as interest and principal on bonds, and any pension fund liabilities. So there are three categories in a balance sheet. You have assets, liability, and then you have equity. Now equity is also called owner's equity or shareholder's equity. That is what remains after subtracting the liabilities from the assets. Retained earnings are earnings retained by the company that is not paid to shareholders in the form of dividends. So retained earnings it's basically, think of it as accumulated earnings. Those are used to pay down debt or otherwise reinvested in the business to take advantage of growth opportunities. So while a business is in a growth phase, retained earnings are typically used to fund expansion rather than paid out as dividends to shareholders. The reason why I'm explaining this to you about the balance sheet is that the balance sheet is a source of formidable analysis when it comes to comparative ratio analysis. And experts and investors look at the balance sheet to see a lot of what's going on in the overall company. Why? For example, the balance sheet is linked to other financial statements. The balance sheet is linked to the statement of cash flows and the income statement. So if you take, for instance, revenue are generated by what? By the assets of the company, right? So you can do a return on assets to evaluate how good, how effective managers are able to transform or leverage the asset to generate sales. You can also look, if you look at the statement of cash flows, there is a category in that statement called operating activities. So cash flows from operating activities. Just to quickly talk about the statement of cash flow here, that statement has three categories, three sections, if you will. So you have cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. And you would see that, and we have an entire show covering rather the statement of cash flows. What I'm trying to say here is that there are linkages, there are correlations between the balance sheet and the statement of cash flows and the income statement for that matter. So cash flows from operating activities are linked to a lot of stuff that happens in the revenue and also in the short-term category of the balance sheet. If you look at the cash flows from financing activities, those are usually linked to long-term debts and other types of funding. So for instance, dividends payments. And cash flows from investment activities are linked and correlated to the long-term asset section of the balance sheet. So by analyzing the balance sheet properly, you're able to know what's really happening in other financial statements. Now let's talk about, that was for the internal company trend analysis. Let's talk now about the external industry analysis. Just as important as internal trend analysis is industry analysis. You want to, as a small business owner, you want to understand the average performance of a firm's industry over time as compared to the individual company. In other words, you're trying to pitch your company, or you're trying to pick a small business versus its competitors to see how the company is doing. Right now, for example, if an industry average ratios differ significantly from a firm's results, especially if they're better, company management would benefit from examining why and perhaps taking action to improve financial results. So by doing that, you're able to measure up against competitors, and ratios are great. Financial ratios are great tools when it comes to comparing and contrasting competitors, because companies also often compare their firm's ratio to competing firms. So after gathering available ratio data from known competitors and similar firm in the same industry, analyzing a firm's performance in relations to, say, its competitors can shed light on any competitive advantages, strengths, or weaknesses the company may have and enhance its strategic planning. This ratio analysis is so important when it comes to SWOT analysis. SWOT stands for strengths, weaknesses, opportunities, and threats. And this sort of financial ratio analysis also informs senior leadership when it comes to, for instance, mergers and acquisition, or just acquisition, identifying acquisition targets. Let's say, for instance, you have a company that has poor ratios compared to the competitors. The competitor might see that there is an opportunity there to change management and acquire the company. Sometimes if the company doesn't do it itself, investors, you have activist investors who constantly track those numbers, and what they do is they would lead the charge and say, listen, either you guys improve the operations and deliver, or we're just pushing for an acquisition or a merger for that matter. All right, so this is for the comparative ratio analysis. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. I'm still here talking to you about profitability ratio analysis, and this is very important. I'm trying to link the importance of this exercise to the health, the financial health of a business, whether it is small, mid-size, or large. Let's now talk about margin ratios. So remember, in the first section, I spoke to you about comparative ratio analysis, internal company trend analysis versus external industry analysis. Now let's talk about the margin ratios. So you have gross profit margin, operating profit margin, the net profit margin, and the cash flow margin. There are 4 margin ratios. But before I talk about them, please, if you enjoy the quality and clarity of this show, you love the content, you are learning a lot, please smash that like button for me, please, and comment below. You can also share the content so that we can disseminate the info to a lot of business owners out there. And also consider subscribing to our channel and turn on the notification bell. We release new shows every single day, rain or shine. So margin ratios, gross profit margin. This calculates the cost of goods sold as a percent of sales. So both numbers can be found on the income statement. Now, this ratio looks at how well a company controls the cost of its inventory and the manufacturing of its products, and subsequently passes on the cost to its customers. So the larger the gross profit margin, the better for the company. So calculate gross profit margin by first subtracting the cost of goods sold from sales. So say if sales are 1,000 and the cost of goods sold is 600, the gross profit is 400. Then you divide the gross profit by sales, which will be 400 divided by 1,000, and that's 40%. So the gross profit margin, which is the amount of sales revenue that can be devoted to utilities, inventory, and manufacturing cost, is 40% of sales. Let's move on now to operating profit margin. The operational is also called operational profit margin. This is generally called earnings before interest and taxes, or EBIT, on a business income statement. Remember, income statement means the same thing as statement of income or P&L, profit and loss statement. So the operating profit margin is EBIT as a percentage of sales. So this measures a company's overall operating efficiency. Now, this differs from the gross profit margin by further subtracting out the expenses of ordinary daily business activities from sales. So the operating profit margin is calculated using this formula. So EBIT divided by sales. So let's say EBIT is 200 bucks and sales are 1,000. Then the operating profit margin in this case is 20%, right? So both terms of the equation come from the company's income statement. We are still in the company's income statement. Let's move now to the net profit margin. So when doing a simple profitability ratio analysis, the net profit margin is usually the most often margin ratio used. The net profit margin shows how much of each sales dollar that is, remains as net income after all expenses are paid. For example, if the net profit margin is 5%, that means that 5 cents of every dollar of sales made are profits. The net profit margin measures profitability after consideration of all expenses, including taxes, interest, and depreciation. What's the calculation here? The formula is net income divided by net sales equals the percentage, and the result is expressed in a percentage. So both terms of the equation here, net income and net sales, come from the income statement. Let's move on to the number 4, the fourth, margin ratios. Margin ratio. Now you have the cash flow margin. The cash flow margin ratio is an important ratio because it expresses the relationship, the correlation between cash generated from operations and sales. So the company needs cash to pay dividends, right? Suppliers, service debt, they have to invest in new capital assets. So cash is just the bloodline of the company. It's just as important as profit to a business firm, and also a nonprofit for that matter. The cash flow margin ratio measures the ability of a firm to translate sales into cash. So the calculation is cash from operating cash flows divided by net sales, and the result is expressed in percentage. So the numerator of the equation, in other words, the cash from operating cash flows, comes from the firm's statement of cash flows. The denominator, in this case net sales, come from the income statement. All right, so those are the four margin ratios: gross profit margin, operating profit margin, net profit margin. All those three ratios, the elements come from the statement of income. And then the fourth margin ratio is the cash flow margin, and that you have the denominator that comes from the income statement, and the numerator comes from the statement of cash flows. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. How are you doing today? I hope you are doing fantastic. We are still here talking about profitability ratio analysis, and I've talked to you about the margin ratios. Now we are going to talk about return ratios. There are three return ratios. You have the return on assets, the return on equity, and the cash return on assets. Let's first delve into the return on asset. This ratio is an important profitability ratio because it measures the efficiency with which the company is managing its investment in assets and using them to generate profit. So it essentially measures the amount of profit earned relative to the firm's level of investment in total asset. So the return on asset ratio is related to the asset management category of financial ratios. So the calculation of for the return on asset ratio is you take the net income of the company and you divide that by total assets, and you get the result in percentage. So net income is taken, of course, from the income statement, and total assets are taken from the balance sheet. So the rule of thumb is that the higher the percentage, the better, because that means the company is doing a good job using its asset to generate sales. The next return ratio, you have the return on equity. This is perhaps the most important of all the financial ratios if the company is publicly held, because investors want to make sure that, because this ratio expresses something very important for investors. It measures the return on the money the investors have put into the company. It is the ratio potential investors look at when deciding, for example, whether or not to invest in a business. So the calculation is you take the net income and you divide that by stockholders' equity, and you express the result in a percentage. So net income comes from the income statement, of course, and stockholders' equity comes from the balance sheet. If you remember, I was telling you that the balance sheet has three main categories. You have assets, liabilities, and stockholders' equity. In general, the higher the percentage, the better, because it shows that the company is doing a good job using the investors' money. Now, of course, as every rule, there are exceptions, but here I'm giving you the general rule. The third thing we want to talk about when it comes to return ratios is cash return on assets. Now, the cash return on asset ratio is generally used only in more advanced profitability ratio analysis. A lot of small business owners don't go as far, but I will explain it. I will explain it anyway here because it's a good one. It's a good ratio. This cash return on asset ratio is used as a cash comparison to return on asset, since the return on asset is stated on an accrual basis. For those who are not familiar with accounting, in accounting you have two rules. You have accrual basis and you have cash basis. I'm not going to get into the nitty-gritty of accrual versus cash here, but just know there are two. So cash is required for future investments. So the calculation is cash flow from operating activities divided by total assets, and you get the results as a percentage. So the numerator, in this case, cash flow from operating activities, is taken from the statement of cash flows, and the denominator from the balance sheet. So the higher the percentage, the better. So now this is very important to understand that there is a model that a lot of big businesses use, especially banks and multinationals, to analyze their profitability ratio to perform their profitability ratio analysis, specifically advanced profitability ratio analysis, and that's called the DuPont model. Now, There are many financial ratios: liquidity ratios, debt or financial leverage ratios, efficiency or asset management ratios, and profitability ratios, that it is often hard to see the big picture. You can very easily get bogged down in the detail. Now, remember, in this show, I've only covered profitability ratios. I haven't covered liquidity ratios, debt or financial leverage ratios, efficiency or asset management ratios. This will be the topics for other shows. Financial managers must have a way to tie together the financial ratios and know where the profitability of the business firm is actually coming from. So the DuPont model can show a business owner where the component parts of the return on asset or return on investment ratio come from, as well as the return on equity ratio. So for example, the manager might be able to find an answer to this question: did return on asset come from net profit or asset turnover? Did return on equity come from net profit, asset turnover, or the business debt position? So the DuPont model is very helpful to business owners in determining if and where financial adjustments need to be made. Nowadays, you have algorithms that provide that kind of service, that kind of calculation as well. But for those who want to dig deeper, who want to perform advanced ratio analysis, the DuPont model is great. If you go on the internet and type DuPont model, you'll get a lot of. There are even spreadsheets. There are even Excel spreadsheets that come with macros embedded that allow you to perform the whole calculation using the DuPont model right away. You can also get software for that. All right, folks. So just want to quickly wrap up today's conversation. I was talking to you about profitability ratio analysis. So I first explained what it is, and then I compared ratio analysis. I took the example of the balance sheet, and I also I talk about external industry analysis, and I talk about the margin ratios, the four margin ratios. So you have gross profit margin, operating profit margin, net profit margin, and cash flow margin. Subsequently, I spoke about return ratios. So return on assets, return on equity, cash return on assets, and to tie everything together, I spoke about the DuPont model. I hope you got a lot of info from this show. I will see you next time, but until next, remember, stay marvelous.